Ever wonder if you had invested just $1 way back in the 1920s, where would it have grown the most today? Stocks? Bonds? Gold? Well, the answer might actually surprise you. Today, we're going to dig through decades of data to see which investments have really stood the test of time. And more importantly, what it all teaches us about building wealth for the long run. It doesn't matter if you're just starting to think about your financial future or if you've been in the game for years. It all boils down to one single fundamental challenge. How do you get your money to work for you when the future is, well, famously unpredictable? I mean, that's the billion-dollar question, isn't it? We're all facing a future that's guaranteed to have booms, busts, and a whole lot of chaos in between. So how on earth do you navigate all of that to build real, lasting wealth for yourself and for your family? Well, here's the good news. While we don't have a crystal ball, and let's be honest, who does? We do have something almost as good, a roadmap from the past. By looking at how different investments have behaved through all kinds of crazy times, wars, recessions, you name it, we can uncover some really powerful, time-tested ideas for building a portfolio that can handle just about anything. Okay, so let's get into it. To really understand this roadmap, we first need to meet the main players on the field. Think of these as the 4 essential building blocks you can use to construct pretty much any investment portfolio. First up, we've got stocks. Now, when you buy a share of a company, say like Apple or Amazon, you're literally buying a tiny piece of that business. Stocks are the high-octane growth engine of your portfolio. They offer the biggest potential bang for your buck. But, and this is a big but, that kind of horsepower means you have to be ready for a seriously bumpy ride. Next on the list are bonds. When you buy something like a U.S. Treasury bond, you're essentially lending money to the government. They promise to pay you back with interest. Think of bonds as the steady, reliable anchor of your portfolio. They're designed to keep the ship stable and provide some income, especially when the stock market gets all stormy. And then there's real estate, the one asset you can literally go out and touch. Whether we're talking about a rental property or a piece of a huge office building, it can bring in steady income. And what's really cool is its value often rises with inflation, which helps protect your buying power over time. And finally, we get to the real wild card of the group, commodities. We're talking about raw materials like gold, oil, even agricultural products like wheat. Their prices are driven by pure, raw, global supply and demand. A drought in one part of the world, for instance, could make wheat prices skyrocket. This makes them way more cyclical and, honestly, just a lot more unpredictable than the other assets. All right, so we've met the players. Now it's time for the main event. Let's pit them against each other and see how they've actually performed in the great race for returns over the long, long haul. So when you look at the historical data, there is one clear, undisputed champion of returns. It's stocks, and it's not even close. They've historically clocked in at around 10% per year on average. But, and I can't stress this enough, that nice, smooth-looking average hides a ton of short-term drama. This makes me think of that classic line from Warren Buffett. He said, "The stock market is a device for transferring money from the impatient to the patient." It's such a brilliant way of saying that. To get those amazing long-term returns, you absolutely have to have the stomach to ride out some really scary short-term drops. I mean, just think about the 2008 financial crisis. It's a perfect test of this idea. Investors who got impatient, who panicked and sold everything, saw their stocks just get crushed. But look what happened with bonds. Our steady anchor, they actually went up. It just goes to show you, the winner in any given year can change in a heartbeat. Which brings us to the other crucial half of the investing equation, risk. So, if just chasing the highest returns isn't the whole story, then what is? Well, the real secret sauce is learning how to manage risk. It's about building a portfolio that can not only survive the market's crazy swings, but maybe even thrive because of them. It really all comes down to this classic trade-off. Think of stocks as a wild roller coaster. You get these incredible highs, but you also get those stomach-churning drops. Bonds, on the other hand, are way more like a calm, steady boat ride. It's slower, yeah, but it's much smoother and it's designed to get you to your destination with a whole lot less drama. Now here is the secret weapon for managing all that risk. See, different assets don't always move in the same direction at the same time. This is key. For example, when the stock market is having an absolutely terrible year,
The bond market is often doing just fine or even great. This relationship, or really this lack of a relationship, is the magic trick to building a stronger, more resilient portfolio.
And this is where it all clicks. Since all these different assets behave differently in different kinds of weather, you don't have to bet everything on just one of them. Instead of trying to pick a single winner, you can build an all-star team. This is a complete mind shift. You stop trying to be a fortune teller, guessing which asset is going to be the hot shot next year. Instead, you focus on assembling a well-rounded team, where different players can step up and carry the load when other players are having a bit of an off day. And that teamwork has a name. It's called diversification. And here's how it works, in 3 simple steps. 1. You combine these different players, stocks, bonds, real estate, into one portfolio. 2. You let the strong performers for that year help balance out the weaker ones. And 3. The end result is that you potentially smooth out the whole ride and lower your overall risk. It's an incredibly powerful concept. So, when you boil it all down, history's most powerful lesson isn't about trying to pick the single best asset. It's about building the best team. Now, of course, the past is our best guide, but it's no guarantee. The world is always going to keep changing. So the final question is really for you. How are you going to use these principles to prepare your team for whatever the future throws at it?